Okay, so Supermicro computer, one of the giants building the actual guts of the AI revolution, well, they just dropped their latest earnings report. And on the surface, it looks absolutely incredible. But, and this is a big but, once you start digging into the numbers, a whole different story starts to unfold. So let's get into it. So first up, the big headline number. Are you ready for this? In just one quarter, Supermicro raked in an insane $12.68 billion in revenue. I mean, that's just a huge, huge number. And it's pretty much all coming from this relentless, insatiable demand for AI servers and all the GPU hardware that powers them. And just to put that into perspective, okay, this wasn't just a big number. It was an absolute explosion. We're talking about a 123% jump from the same time last year. That's not just growth, that's a rocket ship. The demand for AI hardware has officially gone vertical.
So yeah, to call this an explosive quarter is almost an understatement. That $12.68 billion in revenue, it didn't just meet what analysts were expecting, it completely blew past it by more than $2 billion. It was so good, in fact, they went ahead and raised their prediction for the whole year to over $40 billion. Just incredible. But, and here's the big question, is all that insane growth actually profitable? I mean, pulling in huge revenue numbers is great, right? But actually making money from all those sales, well, that's a whole different ballgame. And this is where we get to the real story hidden inside this report. Because you see, lurking behind all that incredible revenue growth, there's a pretty serious problem brewing. The company's profit margins, they're getting squeezed hard. And this, right here, is the part of the story the big flashy headline numbers don't show you.
And right here, you can see the problem in black and white. It's like a tale of two completely different stories. On one side, you've got that amazing 123% revenue growth. But on the other side, well, their gross margin, that's basically the profit they make on everything they sell before other expenses, it's dropped all the way down to just 6.4%. And get this, it was 9.5% just last quarter. It means for every single dollar they're bringing in, they're actually keeping less and less of it.
So why is this happening? Well, the company actually points to a few key things. For starters, a lot of their sales are going to these massive, massive customers. Think giant data centers, who have a ton of power to push for better prices. Then you've got shipping costs. To get parts where they need to go fast, they're paying a premium. There are also shortages of really important components, which, you guessed it, drives up the price. And on top of all that, you've got tariffs adding to the cost. It's really like a perfect storm of rising expenses hitting them all at once. Okay, so this is the big question, right? How is Supermicro going to fix this? What's the plan? Well, it turns out they're making a huge bet on a brand new type of solution that they think will bring those margins way back up. It's called DCBBS, which I know is a bit of a mouthful. It stands for Data Center Building Block Solution. The easiest way to think about it is like a pre-built kit for a data center, almost like giant, high-tech Lego blocks. So instead of just selling you a server, they're selling you a whole pre-designed, pre-tested section of a data center with all the cooling, power, everything already built in and optimized to work together. And here's why this is such a big deal. Remember that tiny 6.4% margin we talked about? Well, according to the CEO, these new DCBS kits have a gross margin of over 20%. That's not just a little better, that's a whole different universe. It could be a total game changer, really a lifeline for their bottom line. And make no mistake, the company is going all in on this. The CEO, Charles Liang, said it himself on the earnings call. This isn't just some little side project. He said, and I quote, "DCBBS is and will become an increasingly important part of our value. It's central to their whole strategy for getting back to healthy profits. In fact, they think it's going to contribute at least double to their profits by the end of this year alone."
But it's not all smooth sailing. Even with this really promising DCBBS plan, the company is walking a bit of a tightrope. The report also pointed out some other pretty big risks that we just can't ignore. And the first one is a doozy: customer concentration.
Get this. An incredible 63% of all their revenue this quarter came from one single customer. 63%. I mean, that is the definition of putting all your eggs in one basket. It's a massive risk. If that one customer even hiccups, if they slow down their orders or decide to look somewhere else, the fallout for Supermicro would be huge, and it would be instant. And that's not the only red flag. 86% of their sales are just in the US. That's a big risk if the US market slows down. Their inventory, the stuff they have waiting to be sold, has swelled to over $10 billion. That's a lot of cash tied up. And even with all that record-breaking revenue, they're still carrying net debt on their books. So when you step back and look at the whole picture, you've got this classic tug of war, right? A real bull versus bear debate about where the company is headed. Let's kind of lay out both sides of the argument. All right, so the bull case, the optimistic view, is pretty straightforward. You've got this insane record-breaking growth that's riding the massive AI wave, and they have a clear plan, this DCBBS thing, to fix their profit problem. Sounds good, right? But then there's the bear case, the pessimistic side, and it's just as clear. Profits are evaporating, they're terrifyingly dependent on just one customer, and the supply chain is a constant headache. So, where does that leave us? Well, it all comes down to one big question. There is absolutely no doubt that Supermicro is a crucial part of the engine powering this AI boom. They are churning out hardware at a mind-blowing speed. But the real test, the thing everyone is going to be watching, is this. Can they figure out how to build not just a fast business, but a profitable one for the long haul?